Improving Alpha Innovation in Investing, ESG and Technology with Michael Oliver Weinberg in partnership with Vidrio Financial. Vidrio Financial is a premier data management provider shouldering the responsibility for your data from collection to extraction, transformation and enrichment. Vidrio monitors over 2,000 diverse funds, processing millions of data points each month. Discover how Vidrio empowers your institutional portfolio data by combining advanced AI and human expertise to yield comprehensive analytics on performance, cash flow, risk, valuation, and more. All delivered seamlessly through Vidrio's Data Management Hub. Save your investment team valuable operational time, providing actionable insights like never before. Explore more at vidrio.com.
Hi, this is Michael Oliver Weinberg. We would like to welcome everyone to the Improving Alpha Innovation in Investing, ESG, and Technology podcast series. Today, Gerd Gigerenzer, Director Emeritus of the Max Planck Institute, will be our guest. So listeners have a high-level sense of our roadmap. We will start with some background, then discuss the usual. Investors, academics, and business leaders should be able to extract a great deal of value from Gerd's insight. On that note, welcome, Gerd.
I'm glad to be with you, Michael.
Thank you. Why don't you start with your background, briefly, how you got to where you are today?
Okay. So I studied psychology and statistics, and I had a career as a musician, so financing my studies. And I had to make an important decision whether you want to stay on the stage or risk an academic career. For me, the safe option would have been music, and I earned much more than at the beginning academic. And so I took the risky option. And that's where I finally made my career. And I've been a professor at the University of Chicago, my favorite university in the world. And I've been professor in many other countries, and long time director of the Max Planck Institute for Human Development in Berlin.
Maybe I'm familiar with your institute as I've had dealings on the financial side with the endowment, but I think perhaps in New York or even more broadly America, people are less familiar with it. Maybe you could just give us very briefly what its objectives are and how it makes the world a better place.
The Max Planck Institutes, and there are 80 of them, their purpose is to do groundbreaking research. And they are very different from universities. So the Max Planck Institutes have three basic principles that might also be interesting for any financial company. First, take risks. And that means to provide the director with long-time funding so that the person isn't dependent on short-term grants and actually can plan not for the next quarter report, but like a family business for the next generation. Second principle is called the Harnack principle, after the first or the founder of the Max Planck Society in 1911, when it was still called the Kaiser Wilhelm Society, but this wasn't no longer politically appropriate. So the Harnack principle is the following. A regular university would have an opening in a field and try to get the best person in this field. That's not what Max Planck does. Max Planck is looking for the best person and hopes that the person creates a new field. That's the difference. And the third is interdisciplinarity. So that means that it's not just on your label, but actually, so in my research group, I had people from about 8 to 10 different disciplines at any point of time working together on a common topic, decision-making under uncertainty, meaning a radical uncertainty, not something that you can tame with probabilities. So these are the key principles of the Max Planck Society, which makes them unique, and that's also heuristics. So in order to get to innovation, you can calculate it, but you need to embody these heuristics like hire well and let them do their job. That's the directors who can just, that doesn't work all the time. There are always a few failures, but if you want to have big successes, then you need to have failures.
It sounds quite unique, contrasted with much of the academic world. For example, based on it sounds as though there's more of an appreciation for the generalist versus the specialist model. Whereas to me, in my experience or observation, most of the academic world is more specialist oriented, square peg, square hole, round peg, round hole. And whereas here you're more willing to say a good athlete has capabilities beyond, and there's more cross-fertilization and cross-pollination. Is that right?
Yes, but you still need specialists. So in my research group, having about 30 researchers from different fields, many of them are specialists, but I bring them together on a common topic. And as a director, I have the overview, but I also need the specialists. So it's getting people to a common vision, but from different backgrounds.
Right.
A major difference to many universities is that a heuristic like hire well and let them do their job. It embodies quality first and then trust. Many universities now run on mistrust. So they ask their professors to list every day what they have done and how much they have published, rather than hiring well and trust this person and let them do innovative research.
Sounds great. Sounds like the old Bell Labs or an optimal research situation.
Mm-hmm. Yeah.
Yeah, go on. Sorry.
So I was just mentioning that it's not only in academia. I observe also in businesses more and more a culture of mistrust. So where one goes away from a culture of success and efficiency and performance to one of where one can explain everything, have reasons for everything, even if the company is down. So it's better to have a good reason for why the performance of the company is bad, rather than have no reason why it's good. That's the culture of a defensive culture in which we live.
So presumably, I think it seems pretty clear to me where you'll come out on this, but there was a suggestion by our current executive branch administration to eliminate quarterly reporting or diminish quarterly reporting. I guess perhaps is a more accurate way to say it. Is it fair to assume you would be a proponent of that in terms of more longer term perspective, or?
You got it. Yes, of course. That's one of the major obstacles to a healthy company. So get rid of quarterly reporting and measure the performance in long-term ways.
But it's just to drill down more deeply into that, because we had, I believe it was Aswath Damodaran, who you may know, professor at NYU, on valuation on the podcast not too long ago. And for example, his view was the quarterly reporting isn't necessarily entirely the problem, that it's the forecasting, that it's the quarterly forecasting or the short-term forecasting. Do you have a view on that?
The problem is, I half disagree with that. The problem is quarterly reporting, period.
Okay.
Forecasting is another. Yeah, in businesses, forecasting are usually quite bad. I've done some studies about forecasting, say, of the exchange rates by the major financial institutions over 10 years, like JP Morgan. So exchange rates between dollar and euro, for instance.
Mm-hmm.
If you look at that, it is, when I show this in a talk, for 1 year, the predictions for next year, and then the real exchange rate. And then the predictions for next year's and the real exchange rate. So you have 24 of the most stellar, most well-known financial companies. Most of the time, the true value is out of the entire range of the predictions. And while the predictions don't work, one can easily predict the predictions. So if the exchange rate went up, predictions are it will go up next year too. If it went down, predictions are it will go down next year too. So these predictions overlook every change in direction. So as a specific statement in general, one should not predict things one cannot predict. And that is a kind of modesty. For instance, when I worked with the Deutsche Bank, I gave a talk to the people, to the entire leadership, including the people who make the predictions about exchange rates in this case. You can do this with other variables. And then I asked, is there anyone in the audience who made these predictions? So the predictions are like the others, they're worthless. And the people who made the predictions said, yes, it's us. So I asked them, why do you make these predictions? And they said, yeah, we know they're not good, but there's a demand. So I asked, whose demand? And they said, yeah, it's the companies. And the CEO doesn't want to make their own prediction, because if something goes wrong, he or she would be responsible. So they ask us to make predictions. And it doesn't matter how good they are. It's about delegating responsibility. That's called defensive decision-making. So that's part of the structure in which we live. So I would say, going back to your example, cancel quarterly reports and cancel quarterly predictions and focus on good performance in the long run. And of course, you have to change the remuneration rules for the CEOs. Yeah.
And is there an optimal periodicity of reporting then? If it's not quarterly reports and quarterly forecasts, is it a year? Is it beyond that?
And there is the world of business is a world of uncertainty, meaning Knightian uncertainty, named after Frank Knight, the founder of the University of Chicago School. Under uncertainty, there is nothing optimal. It's impossible to know, and the term optimal is misleading. So what you can say, long-term, will depend on the kind of business in the order of years. But there's no way to say it should be 1 year and a half or 2. So one has to learn to live with that uncertainty. But any of these is better than quarterly reporting.
Understood. That's clear. Why don't we go through a few of your books chronologically? Because I think you make great, I've read many of them, and I think you make great points in them that are relevant to investors defined as allocators or investment managers. Maybe starting with simple heuristics that make us smart, and perhaps you could contextualize how institutional investors could use their adaptive toolbox.
Yeah. So in simple heuristics that make us smart, we make a difference between situations where you can optimize. These are basically well-defined, stable situations, and situations where you can't, which are unstable. They're often called VUCA. So there's uncertainty, and you can take yesterday to predict tomorrow. The basic insight is, if you have a stable situation, then you can optimize, or even if it's intractable, then you can at least make complex algorithms work. A stable situation is the area of complex algorithms. So to use another example, the AI succeeds in well-defined problems like chess, Go, machine applications that are where yesterday is tomorrow, or ChatGPT, where the correlations between words don't really change during the time we are. But complex algorithms have problems predicting, for instance, human behavior. And we still don't have a self-driving car, meaning level 5. We do have level 4 cars, but it's too difficult. And the problem is uncertainty. And much of uncertainty comes from humans. In that case, from human drivers who don't follow the rules. So the same principle applies to the financial situations as everywhere in the world. And under uncertainty, where you can't optimize, where optimization is an illusion, although the term is always used, you need to have smart heuristics. That's the key message here. And heuristics are simple rules that are robust and that don't overfit, to use a statistical term. And overfitting means basically that you fit your data that you have is always from the past, and you fit on this data, and the future is different, and then you have overfitted.
I think we'll save the AI for later, speaking of overfitting. But let's go to the next book, Calculated Risks, or rather a subsequent book, Calculated Risks, How to Know When Numbers Deceive You. The question I have from there at a high level are institutional investors immune from misunderstanding absolute versus relative risk? And maybe you could preface that a bit.
Yeah. Let me explain what the difference is. I discuss it mostly in medical examples. I'll give you an example in that. So the UK has a lot of beautiful traditions, like the scones and the tea and the Queen, the late Queen, and but also the contraceptive pill scare. So the most famous of them work this way. The medical societies in the UK announced, and the press repeated that the contraceptive pill of the new generation has 100% higher risk of a thrombosis than the one of the previous generation. 100%. That is certain, or isn't it? Many young women believed so and stopped taking the pill, which led to an estimated of 14,000 abortions more than usual in 1 year in England and Wales. What does 100% mean? 100% is a relative risk. So the study had shown that out of every 7,000 women who took the pill of the previous generation, one had a thrombosis, and out of every 7,000 who took the pill of the new generation, that increased from 1 to 2. That's 100% more. The absolute risk is 1 in 7,000, from 1 to 2. So the absolute risk is tiny. The relative risk is huge, a big number. So the problem is that still many people, including doctors and financial people, don't understand the difference between relative and absolute risk. And in this case, this led to these 14,000 abortions more than usual. They could be avoided by teaching people the difference between relative and absolute risk. And that's not very difficult.
No.
I think it's much simpler than baseball statistics.
I think that's right. I mean, look, to me, what you say is obvious. And I think to the smart and better and best investors that I know, it's also obvious. But I guess my sample set is probably unique and not indicative of most of society or the world.
Yeah. There are very few studies about the statistical competence of financial professionals. There's one by my collaborator, Dane Goldstein, and Nassim Taleb, the author of The Black Swan. And they have asked professionals in finance what volatility means. Now, the majority did not know.
Maybe I'm overestimating my peer group. Go on.
Yeah, it could be. Just ask your peers. The majority thought it's the absolute deviation, but it's the standard deviation.
Sure.
And that's bigger. So they underestimate the volatility by confusing it with the absolute deviation. And
Right.
I also have another data point. So I'm also the director of the Harding Center for Risk Literacy, which is funded by an London hedge fund manager, David Harding from Winton Capital. And he read an earlier book that's called Calculated Risk in the US. In England, it's called Reckoning with Risk, but the US editor thought that in the US, nobody will buy a book that has reckoning in the title. The British don't care. They think it's important. So David Harding gave me millions for this, and I'm very grateful to him for founding this Harding Center for Risk Literacy in Germany. He usually gives his money to his alma mater, the Cambridge University. They gave 100 million, by the way, recently. And when he came to the opening of the Harding Center at the Max Planck Institute in Berlin, he said, when I read Gerd's book, Reckoning with Risk, or Calculated Risk in the US, I was totally surprised that most doctors don't understand health statistics and most judges or lawyers don't understand, say, DNA statistics. I always knew that my financial colleagues don't understand statistics, but this was new.
That's funny.
It might be that actually just do a test. Ask about volatility.
Right.
Or
Well, your point with physicians, I mean, it's like there's the whole statins. Anyway,
Yeah.
I've seen what you refer to live, obviously, as I think many of us have, in terms of misinterpretation or misunderstanding of numbers with drugs and studies and physicians, and in the Wall Street Journal and the New York Times every week, etc.
Yeah, and it's actually important to so, for instance, take an example from healthcare that is for most people relevant. So you are a male, and your doctor probably may advise you to take PSA test for detecting prostate cancer early, and you think that is reasonable, and you don't look at the statistics. Now, I have trained in continuing medical education over thousands of doctors, and I know that most of them don't know the evidence in their own field. So most of the urologists don't know the only 2 studies that exist, randomized studies about prostate cancer screening. The result is that there is no evidence that prostate cancer screening saves lives or prolongs lives, but the evidence is usually couched in there's a 20% relative risk reduction in prostate cancer specific mortality. And that's very similar to the example I gave before, namely, this means 1 in 1,000. It's tiny, from 5 to 4 in 1,000, and that's how it says 20%. And again, this is the prostate cancer specific reduction. The total cancer reduction is 0. There's no life saved. So statistical thinking might be actually relevant for everyone in finance. And if you're women, it's the same thing with mammography, where the estimates are even worse. But it's big business and conflicts of interest. And since most of doctors have never learned to understand health statistics, the doctors don't lie to you if they recommend that. They just don't understand their own studies. So ask your doctor about the evidence.
Couldn't agree more. Yeah.
As a man, you end up incontinent and impotent just because you didn't look up the health statistics.
Yeah, it's similar with statins, and if I'm not mistaken, the statistics with statins, and it has
the effect of that is bigger. So for people who are already in a risk group, that is, maybe have already had had a heart attack. Then the effect is in the order of 1 in 100, meaning out of 100 people in that risk group who take statins, one will die or get one fewer will get a heart attack within the next, say, 5 years. That's also them. And since the effect is between 1 and 2 out of 100, so it's couched as a 50% risk reduction from 2 to 1.
Exactly my point.
Mm-hmm.
Exactly my point, which is, yes, we're on the same page. Yeah. In any case, but moving on, since there's a lot to talk about, let's move to another book, a subsequent book, Gut Feelings, the Intelligence of the Unconscious. How does less versus more information improve investment decisions? Obviously, you talk about it broadly, but
yeah. So the general point is that since you're probably not only investing in government bonds, which are fairly stable and safe, but in an uncertain world where you can actually make big money, and in this situation, simple investment strategies will be more robust and reduce overfitting. So I give you an example of a very simple one. You may have heard of Harry Markowitz, everyone in your field. Harry Markowitz got his economics Nobel for a portfolio method, the mean variance portfolio. And when Harry Markowitz made his own investments for the time after his retirement, so we might think he used his Nobel Prize winning method. No, he didn't. He used a simple heuristic that we call 1 over n. N is the number of assets. So if you have just 2, you do 50-50. If you have 3, you do a third, a third, a third. So, and that's a heuristic. And his Nobel Prize winning method is an optimization method. Now, applying the optimization method in a world of uncertainty, that may be a problem. It's the wrong place. So the question is, how well do simple heuristics like 1 over n in the actual world of finance? And there are a number of studies. Some of these studies, like of the Miguel, they report that in 7 tests in real markets, so Markowitz against 1 over n, the 1 over n made more profit according to Sharpe ratio and similar criteria. Other studies report that it's the other way, but the real question is what we call the question of is a different one of ecological rationality. Find out the conditions where a simple heuristic does better than a complex model and where the opposite is the case. That's the real question. The question is not whether 1 over n is better than Markowitz or some Bayesian method. That's the wrong question. Nothing is the best in every situation. And if you think a little bit, you can see the more volatile the situation is, that speaks for making it simple at the extreme 1 over n. The more data you have, assuming that the world is stable, then you should go for complex method. And on the other side, if you have more, if n is large, if a real large portfolio, then that speaks for a simple heuristic, because the more in the Markowitz or Bayesian method, you have to estimate all the covariations, and that creates more estimation error. So that's the same principle as before. If it's fairly stable, the world, make it complex. If it's not, keep it simple. But you need to have some kind of courage to make it simple, because people will point out you haven't looked at that, you haven't looked at this, you haven't looked at that. Yes, that's the idea. We don't look at that under uncertainty. We want to make it robust and simple.
So a bit of the Occam's razor principle.
Yes, but not as a universal principle. If you are under uncertainty, I mean Knightian uncertainty, where your probabilities are an illusion, then make it simple. If you have a situation which is stable, where nothing happens, then make it complex.
Effectively inversely correlated.
Yeah. So And that question is the question of ecological rationality. Find out where a certain heuristic work, like imitation is another heuristic. And you shouldn't imitate everyone. The question is when and where. But that's the hardest question, because most people think that there's Bayesian. Bayes is always good. It's an illusion. Bayes is not always good. Or expected utility maximization. No. They work in stable, small worlds, but not in the world where most of us are.
Yeah, I think that is a prevalent conception again, among some of the smarter financial and scientific minds I know, that Bayesian is always good. Could you drill down a little more deeply into that as to when and where or why it's not always good?
I'll give you an example. It's called the turkey illusion. So assume you are a turkey. It's the first day of your life, and a man comes in, and you fear he will kill me, but he feeds you. Second day of your life, the man comes again, and you fear he will kill me. No, feeds you. Third day of your life, same thing. By Bayesian probability updating, you may start with uniform priors about being killed or not. And every day, the probability that you will be fed and not killed, so it's higher.
Right.
And at day 100, it's higher than ever before. But it's the day before Thanksgiving, and you're dead meat. As an example, this is a world which is not stable from the point of view of the turkey, and Bayesian updating is an illusion. So if you look, it's called turkey illusion. So Nassim Taleb has dwelt on the term turkey illusion. It's from Bertrand Russell, who used the example of a bird. But in reality, it's us people who commit this turkey illusion, because we believe in Bayes, we believe in a stable world, or want to believe in it. So think about the time before the financial crisis of 2008. If you look at the volatility index, it went down and down and down, and suggested everything is getting better, until shortly before the crisis struck. That's an example of a turkey illusion in the real world. And many people have, till the last moments, asserted that everything is okay. And famous economists like Robert Lucas had, in 2003, pronounced in his speech as president of the American Economic Association, that the problem of Great Depressions has been solved forever by macroeconomic models. 5 years later, one of the largest depressions hit. The problem is that the macroeconomic models assume a world that is stable in order to be able to optimize. And economics and financial theory need to move out, finally make the distinction between worlds which are stable and worlds where they need a different methodology. And heuristics are the methodology. But we still live in an academic world where people look down at heuristics and think they're second best. No. Under uncertainty, optimization is second best.
Yep, very sensible. Let's shift to Risk Savvy, a subsequent book of yours, How to Make Good Decisions. And the question we have there is, are institutional investors, and we touched on this earlier, but we'll hit it again, also risk illiterate? To your point on standard deviation or lack of knowledge thereof, yes, but any other thoughts?
So I've done studies on ordinary people who invest, and it's very consistent with the situation in healthcare. Most of them don't understand the statistics and don't notice it. That's the point. That's also for many doctors that I've trained. They don't understand statistics, but they don't notice that. So they believe that, say, 50% reduction by statins means that out of 100 people, 50 benefit. So they don't notice that. That's a typical situation. That's the problem. Same for politicians. The few politicians that have been studied in the UK, the majority of them are innumerate. to an amazing degree. And then think about Brexit numbers. So we do have a general problem in risk literacy, and we need to make progress. We need to teach not just statistics, but in finance, when we have to deal with uncertainty, we need also teach financial heuristics. That is almost never done. So questions about when does simple diversification like 1/n work? Or what are the heuristics of successful investors? So for instance, I've worked with one billionaire who made it from zero to the billions himself, and he had only one heuristic. That is, borrow money from low interest countries and invest only in high interest countries and only in state in government bonds. That's his heuristics. You can see the logic, but it is simple as a heuristic, but to make it work, you need to monitor very carefully. In his case, that meant he is borrowing money in the Western world and he's investing basically in Africa and in South America. And then you need to monitor precisely the financial situations in these countries, potential upheaval, a downgrading of the currency. So there's lots of detailed work to be done. And that's a very different approach from following long-term capital management and such things. So using probability theory.
In that example, he's investing. You're talking about real rates or nominal rates? He's talking about.
He is as far as I know, real rates. Huh?
Because to me, it would seem inherently. Then it would seem to your point inherently. You're basically, you're borrowing. It's the carry trade, right? You're borrowing in Japan and possibly Europe and/or the U.S. and/or Britain and more debatable lately. But and then you're investing in, to your point, South America, Africa, or Asia, or other high rate countries. But then real and nominal rates are two different things. And to your point, you're subject to all the various.
Right. You're right. And this is just an example for a number of heuristics that investors might think about. It is not the only one. Sure. But it's a different kind of thinking than traditional financial theory. There are no probabilities, there are no utilities, but there is a vision of making it simple, going for something robust, and then doing defined work. Even in another heuristic I mentioned before, 1/n, you have at some point you have to rebalance because after a year, your stocks are no longer the same. You have to rebalance, and then the question is, when should you rebalance? And there are many other questions. What is the unit of n? Is it individual stocks or is it larger units? So all these questions are there to be solved, and almost nobody studies that because financial theory dominates.
Sounds like a good Nobel Prize for someone like yourself.
Yeah, but Markowitz would not have gotten a Nobel Prize for 1/n. Yeah, although he used it himself, and in many studies does better than his own. There is a complexity illusion, and at the bottom is that too many people don't distinguish between situations of uncertainty, meaning not just not knowing the probabilities, but not knowing what can happen. So for instance, and not between uncertainty and risk, the distinction is still not made because improper, because they like to use what they learned, probability theory. Probability is a beautiful tool, but it doesn't work under uncertainty. And what happened to Myron Scholes and Robert Merton is that something unexpected happened. They have optimized everything and created a highly leveraged fund. And the choice of assets was based on very sophisticated statistical analysis of high-frequency data over a decade or more. But then something rare and unexpected happened, the Russian default. and the devaluation in the summer of 1998. And then everything breaks. Optimal, if you do something optimal in a world of uncertainty, it becomes fragile. And it may work for years, as long as the world is stable, but then it breaks. And we need something robust that not only works for years, something that in a world of stability may have fewer returns, but doesn't need so. But it's robust if the big losses are coming.
Right. It sounds like you're on the same page as Nassim Taleb and his fragility and anti-fragility and all of that there.
Yeah, no, I have all respect of Nassim. He's a good friend of mine. I only wish he would be a better diplomat.
Yeah, I had
And it's amazing of someone who has very little academic background, but still sees where the problems are.
Right. Okay. Moving on to another book, or a more recent one, or relatively, How to Stay Smart in a Smart World. So I think this is a great way to sort of touch on AI. What impact does AI have on portfolio managers, asset allocators, and Wall Street more broadly in terms of how decisions are made, returns, and employment for the industry?
Yeah.
And I know that's about 6 different questions in one, but
yeah. Let's start with the situations where AI helps and where it does not. So again, the first misconception is that AI solves all problems. There's no method that solves all problems. And one has to repeat it all the time because the opposite is suggested quickly. Yeah? So the same principle applies. I call this the stable world principle. AI is best when in a well-defined world, or at least in a world which is stable, where tomorrow is like yesterday. And a classical example are games like chess and go, industry situations, and so on. AI has problems under real uncertainty. So where things happen that wasn't in the data, no surprise. For instance, predicting human behavior is extremely difficult. So examples would be the prediction in court, in US courts, where the courts have, the judges have systems like Compass that predict whether you as the defendant are likely to commit another crime, or you should get bail or not, this type of decisions. There's little success there. They don't do better than, in one study, than ordinary people who know nothing about this situation, so-called Amazon Turk mechanical workers, who also have no time. They just want to get through these problems. And Compass couldn't beat them. But they are sold with the usual benefit that people don't have good statistical knowledge and don't know that this just can't work. So that's the first thing. If you're in finance, if you're in a situation that's highly volatile, where you don't know, where there's uncertainty, then just bet on experience and intuition and on simple models. If you're in a situation which is stable, then AI can help you. AI is very helpful in administrating data, not so in predictive AI or generating summaries like large language models can do. And so that's the first distinction. And consistent with that distinction, I've looked at the studies that have tested robot advisors. So robot advisors, they're sold by almost everyone, and they do the investment for you, and it's AI. In one study, they tested 37 or so robot advisors against a benchmark of a completely traditional portfolio, half in stocks, half in bonds. And 35 of these 37 performed worse than the traditional benchmark, 2 above it, but that's probably chance. So always look at the data. And if you understand a principle like the stable world principle, then you can already guess whether it will work or not.
Since we're running out of time, what's a book you would recommend outside of one of your own? Obviously, yours are great, and we've touched upon them, and as I mentioned, read multiple of them. But what anything you've read recently, or that you think highly of, perhaps related to this, or could be orthogonal?
Book that's related to this is a book by Kay and King. So John Kay and Mervyn King. called radical uncertainty. They're both economists, and Mervyn King was the former the former governor of the Bank of England. And they really take uncertainty seriously. While in most of finance theory and also in decision theory, uncertainty is confused with just lack of probabilities. And then the Bayesian way jumps in. Uncertainty means that you cannot foresee things like the Russian default. And our world is like that. It's not stable. We cannot foresee everything that can happen. So that's a nice book. Another book in the area of finance is the new edition of the book by Anat Admati and Martin Helwig, The Banker's New Clothes. It's also an eye-opener from a very different perspective than that from Kay and King and my own perspective. Yeah, that's something.
No, go on, please.
Yeah. No, I'm reading all kind of things. Currently, I'm reading the 1964 report about strategic interaction and conflict. That was the report by the Cold War situation, where game theory and expected utility maximization became so prominent because people hoped that there would be a purely rational way in order to prevent the emotions of a Khrushchev or a Kennedy that could lead to a nuclear shootout. And that's my interest. I want to understand how this idea that you could capture rationality by something that is without content and without context came from. That's what we still have in finance, this idea. You can make finance theories without knowing anything about the finance. And you can make macroeconomic theory without knowing anything about the market. Just sit down and draw curves.
Garbage in, garbage out.
But it's still Nobel Prizes. You can win with that. And the role of experience, of heuristics, and also of intuition has been downgraded wrongly. So, for instance, Albert Einstein already always praised his own intuition. And he said, the intuitive mind is a sacred gift, and the rational mind is a faithful servant. We have created a society that honors the servant and has forgotten the gift. He was so right. And at the end, you need both. You need data and you need intuition. If the world would be totally stable and predictable, we wouldn't need intuition. We wouldn't need any heuristic. But that's not the world in which we live. And we need to have the courage against the current trend of behavioral economics, which has a disregard for heuristic. That's the Kahneman and Tversky tradition. We need to realize, and Kahneman and Tversky never distinguished between risk and uncertainty, and even called risk uncertainty. So we need to realize that in the real world, where it's mostly uncertain, we need to take heuristics seriously and also uncertainty seriously.
Anything we didn't discuss that I didn't ask you, or let me retract that. There's a million things you've written so many books, and there are a million things we didn't discuss. But on anything that's brief that we didn't discuss that I should have asked you, or that you think investors should know or be aware of.
I mean, we can only capture in a hour so far, and everyone is invited to look into the books. And also, it's important to have also the courage to see in a different direction than where most of us is going. And that is take uncertainty seriously. That means a world where probability, because we cannot know everything with probability. Take heuristics seriously. And in terms of institutions, be aware of defensive decision-making. So that is when people try to protect themselves and doing unnecessarily complicated calculations in order to justify their doing, rather than make it simple. If it's about uncertainty, find the robust strategies, the simple strategies, and have the courage to go with them.
Sounds like great parting advice. Well, Gerd, we'd like to thank you for that fabulous discussion and sharing your most valuable asset with us, your time. We hope listeners have a better appreciation for one of our more thoughtful thinkers and academics and experts is thinking about, and that you may benefit from this as investors and allocators. This is your host, Michael Oliver Weinberg, hoping you join us again for our next episode, where we speak with another thought leader who will provide insight into improving alpha via innovation. Thank you, Gerd.
It was a pleasure to talk with you, Michael.
Thank you for joining us on the Improving Alpha Innovation in Investing, ESG and Technology podcast, presented in partnership with Vidrio Financial and sponsored by Alternatives Watch and PEVC Tech. Vidrio Financial offers a cutting-edge data management solution that not only collects and cleans your data, but also empowers investment teams to cut through the noise and extract valuable insights for better decision-making in areas such as valuation, risk assessment, and portfolio management. If you're an endowment, foundation, pension, sovereign wealth fund, asset manager, OCIO, or family office facing challenges with your data pipelines, we invite you to connect with us today and explore how Vidrio can seamlessly integrate with your investment team to enhance your data management capabilities. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Vidrio Financial or our host, Michael Oliver Weinberg. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.